be pretty strategic about when you decide to switch. People kind of underestimate how much work actually goes into it. If you can spend an incremental hour on real estate, and that is actually going to generate more income for you than it would if you're doing that additional hour at your current job, then I think if your goal is to maximize your income, it makes a lot more sense to switch.
Welcome, everyone, to the Road Less Traveled Show. This is a show about people that were successful in a previous career and left that career to go down a different path. I'm your co-host, Richard Coyne.
And I'm your co-host, Bill Zahller.
On today's show, we're so pleased to have Kunaal Kumar with us. Kunaal, welcome.
Thanks for having me, guys.
Absolutely, Kunaal. Thank you. Well, again, thank you for being on the Road Less Traveled Show. To start with, can you tell our audience a little bit about your background, what line of work you were initially in?
Sure. So I used to be a software engineer at a big tech company up until this year.
Okay, excellent. And then what have you transitioned into?
Yeah, so now I do full-time real estate. So I built a small real estate portfolio for myself. I've also gotten into more commercial real estate as well. So I've syndicated an apartment building. And more recently, I'm primarily focused on running a more institutional scale debt fund. That's what I've been up to.
Okay, well, that's quite a few different channels there as you've gone through. Did you start out like single family like most people, and then got into multifamily and then into debt fund, or?
Yeah, so I mean, generally, like when I do things, I try to have some sort of angle where it's like I have some sort of edge in the market, or like some sort of competitive advantage. So when I started doing single family, so I mostly bought single family around like the greater Seattle area. And generally it's pretty difficult for anything to cash flow up here, especially for single family, because the prices are so high relative to the rent. So the way I actually went about it was, instead of buying a house and just renting it out to a family, I actually bought larger single family houses and added bedrooms to them. And so what actually ended up happening was I converted one house into a 7-bedroom house, and I actually rented it out by the bedroom. And so, I just rinsed and repeated that. And that actually generates a lot more cash flow than just renting it out to a family. So that's kind of how I started out.
Oh, excellent. Yeah.
Yeah, I've heard of that strategy. And so you're effectively, that person is renting the bedroom, and then they have access to the common space, I guess, right?
Yep.
And then it's up to them to figure out who cleans the kitchen and all that other stuff. You can still well clear of that stuff, right? You don't have to get involved at all.
So no, so I actually did. And so the reason is because basically my strategy was to just avoid as much conflict as possible between roommates. So actually what I did is I included a monthly cleaner to clean all the common areas.
Okay.
And then also for any shared space, like for any like shared bathrooms or anything like that, I would actually provide all the supplies like toilet paper, hand soap, stuff like that. So then there's no discussion about, like somebody's not carrying their weight or doing anything like that. It's just, you just eliminate that problem entirely. So that's how I did that.
Okay, actually, that's a smart way to do it. Definitely create less friction, and therefore easier time for you just to make sure you're getting paid and collecting rent. So very nice, very cool.
Yeah, exactly.
Good. I like that idea. Yeah, very nice. And then if you would touch on your debt fund a little bit, so can you talk a little bit about how that works and what that is?
Sure. So I mean, like at a high level, I think one thing that switched in my real estate strategy over the past year or so is I've actually shifted away more from equity investing to debt investing. And the reason for that is pretty simple. It's just that I've seen in the markets like a pretty big shift from the risk and reward trade-off for equity versus debt. I don't remember the exact numbers off the top of my head, but if you look at, there's a couple of like multifamily indices. I think one is like the Freddie Mac multifamily index. I think like the average cap rate that multifamily is trading at right now is somewhere in the 6s. But if you look at like CMBS yields, like commercial mortgage-backed security yields, over the past year, as the Fed has increased interest rates, yields have actually spiked a lot in that space. So I think like you can literally buy a CMBS at around like a 14% yield right now, versus like getting 6% on your money just buying multifamily in cash. So I think like that kind of inversion has really pushed me away from equity investing in the short term. And so that's why I started focusing more heavily on this debt fund. So for that, the way it works is pretty interesting. So we basically buy notes on single family renovation loans. So generally, like the interest rate that you get on that is already pretty high. Like we can originate debt at around 11 to 12%.
Hmm.
but then we actually do some financial engineering on the back end. It's a little complicated. I can get into the weeds if you guys want later, but
Nah.
basically we're able to actually increase the yields from 11 to 12% all the way up to around 20%. So we've been doing around, so we've had the fund in operation for about 2 years. And over the past 2 years, our average return has been 20% annualized. So kind of what I've been focusing on lately.
Okay, nice.
Okay.
So you're seeing the investors are getting nice returns. They're not getting the upside from partial ownership of a property when the property sells, but it doesn't matter because they're getting great returns along the way. So very nice.
Yeah.
Okay.
Yeah. And like the way I think about that is like, if you're getting 100% of your returns in cash flow, like your cash flow is basically the same thing as your IRR. So
Yeah.
if we're doing 20% annualized, well, our IRR is 20%. So I mean, like a lot of apartment deals that I've been seeing lately, like their IRR is not 20%. It's like closer to like mid-teens, maybe even some I've seen even low teens. So I mean,
Yeah.
yeah, you're not getting appreciation on the back end, but like if you include the back end and back out the IRR from that and it's still lower than 20%, like there's for me personally anyway, I don't have access to deals that are more than 20% IRR, so it
Hmm.
doesn't really make sense for me to invest in those at the moment.
Yeah. Okay. Very nice. Yeah, that makes
Mhm.
sense. So, Canal, to your software engineering days, I know you worked with a bunch of funny people. So, is there a funny story that you can share something that happened to you along the way?
Yeah, I mean, nothing too specific in terms of a story, but I do think it is funny that I was in software engineering for less time than it actually took me to get my degree. So, I mean, I did a 4 year degree in computer science and I was in software engineering for a little bit less than 3 years. So,
You
I
came
guess
in,
that's kind of interesting.
came in, mastered it. You're done. Time to move on, right?
Yeah, pretty much.
There you go. Nice, nice, good deal.
Well, excellent. Well, as you mentioned, the transition, you were, obviously fairly short in the what you went to school for as far as the engineering. So what made you transition into the real estate side of it? It was just you saw an opportunity, more entrepreneurial bent. What was your guide on that?
Yeah, so it's pretty interesting. So, I mean, to back up, like why real estate specifically, back when I was in college, so I actually graduated in 2020, so in the middle of COVID. And so I always knew that I didn't want to just only work a job for the rest of my life. So I was always trying to figure out some entrepreneurial thing that I could get into on the side. And so I think around my junior year of college, I randomly found the Bigger Pockets podcast. And so I started listening to a few episodes here and there, and I was like, oh, this is kind of interesting. But then, like when I was in COVID, I had nothing else to do with my time really. So I think I literally listened to 300 episodes, the Bigger Pockets podcast, in like 6 months. I just did it for fun, and so I passively learned a lot about real estate through that. And I think I found that there's like a lot of different ways to make money in real estate. But not only that, I think my framework around it is I think that there's a lot of ways to get a competitive advantage in real estate. Uh, for context, like back when I was in school, I was also really thinking about going into quantitative finance. So that's kind of like algorithmic trading at hedge funds, like these kind of high frequency trading, things like that. And so in that realm, like whenever you're trading against like physics PhDs from Stanford, like people who've been doing this for 20 years, versus like real estate, like sometimes you're competing with sophisticated people, but other times you're competing just against moms and pops. So I mean,
Mhm.
I think that was one thing that really made me think about real estate a lot more. And so as soon as I started working full time, I was like, okay, I want to buy real estate. So I started building slowly my single family portfolio. And then while I was working also, I just kept networking with people. So I met uh I guess you could call my mentor. We worked together on a couple of deals. So I syndicated an apartment building with her and we do a bunch of developments in Seattle. And I just kind of grew from there. But that's kind of how I got into it. And then so I slowly built this up while I was working. It's not like I quit and then started.
Yeah.
Mhm.
Okay.
Mhm.
Yeah.
Very nice. When you did get started, you were still working a full-time job, like you said. Were there some obstacles you had to overcome, some things that you had to, figure out how to get past and move beyond?
Yeah, definitely. I mean, like, so I think the way that I did it is I kind of tried doing the thing that took the least amount of effort. Essentially, I think I'm like relatively lazy. So, I mean, I'm always trying to find like the least burdensome way to do things. So
Hmm.
the first thing I did was, like I mentioned, I started out doing like rent by room, but I actually made it a little bit easier on myself and I actually kind of house hacked it. So I bought the property and lived in it. And so I think that really helped in a couple of ways. One is like my down payment was super low. So I could use a lot of leverage to juice my returns. But the other thing that made it easier was, I mean, I lived in the house. It's either like I was going to rent and like set up my own apartment for myself, or I could buy a property, set up a property for myself, and then also have that carry over to renting it out to other people as well. So I think that kind of made it a little bit easier for me. I think the other thing that helped me out was honestly because like it was COVID and like work from home and stuff like that. That actually helped me like reorganize my time a bit better. So like during the day, if I needed to go see a property or something like that, I could just go out and do that in the middle of the workday, and then I could shift my work around so I could get whatever I needed to get done later in the evening. So I mean, I kind of just like used strategies like that here and there to not make it super difficult. And yeah.
Okay, cool. Yeah, yeah. Well, they say necessity is the mother of invention. I think laziness is the father of invention.
Yeah.
And and again, I kind of look at that as not laziness. I look at it as efficiency. Figuring out how to do something better and faster, and with less effort. Why not? That's great. That's brilliant.
Mhm.
So yeah, nice.
Well, as you think back, I mean, when you started into the real estate side of this, can you think one of your first victories that kind of cemented the idea like this is a good plan path forward to get into real estate and scale on that?
Yeah, I mean, honestly, I think once I got that first property fully rented out, that was like a proof of concept that this worked. So, I mean, back at the time, rates were super low. So I locked in like a 3.2% interest rate on my first house. And I mean, when you do a rent by room, like the gross rents are pretty high. And especially if you have 7 bedrooms. So like I was grossing around like 7,700 a month on that one property. And my monthly mortgage was like 3,500. So like as soon as I saw that, I was like, this is crazy.
Yeah,
That's
Yeah.
great. Yeah. Wish you
Mhm.
picked up a dozen of those probably. But
Yeah,
yeah,
for sure.
looking back, yeah.
yeah. Wow, that's pretty incredible. Yeah, definitely
Mhm.
nice cash flow on that. So for sure.
Right.
Yeah, usually you don't hear about any more than triple. 3-digit returns on a monthly basis is really good, and so, but if you're hitting four and 3,000 plus cash flow a month, that's great. So wow.
Mhm.
More recently in your real estate days and your debt fund days, is there a funny story you could share, something recent?
For the debt fund, I mean, honestly, not really. I mean, it's still kind of early in that space also. So,
Yeah, yeah. Oh, good.
Okay.
That's all right.
Yeah.
Yeah, definitely. I'm sure, along your figuring out how to engineer, like you said, to juice the returns. I'm sure there's definitely a few comedy people you're working with. I'm sure in the background, but all good. So let's keep going. Yeah.
Well, where are you today at your journey? Like, so do you sound like are you still doing syndication and the debt fund, or are you mainly focused on the debt fund going forward?
yeah, so I mean, primarily the debt fund. I think, in my personal opinion, like I try to follow like the economy pretty closely and like follow these macro trends. So, I mean, I think in my personal opinion, I still see some cap rate expansion coming down in commercial real estate. So I think my current strategy is to really focus on the debt fund, scale that as much as possible, and then maybe in a year or two, I'll return to the multifamily or commercial space.
Hmm.
But yeah, it's just like I mentioned. I think for me personally, like I'm not able to generate the kind of returns that would necessitate like taking on that much risk in the multifamily space. So at the moment, I'm pretty much paused on that. So even in the single family space, I haven't bought any more rent by rooms in like the past year, just because I think like again, for me personally, I think the debt fund is the most reasonable thing to do right now.
Hmm. Great.
Yeah,
Yeah.
that makes sense.
Hmm.
So, Kunal, is there something you do either personally or through your business that you can do to help others that you can mention, share with our listeners?
Yes, I mean, like the biggest thing that I actually really enjoy doing is like helping people out who are earlier in the journey and giving people advice. I mean, I have a lot of friends that see what I'm doing and they're like, oh, how do I get involved? Or like, how do I do this for myself? So I love like either bringing people to invest along with me or just giving them advice and telling them how to get stuff set up.
Mhm.
Also, like I have like random people reach out to me on LinkedIn on occasion. I post a lot on LinkedIn, especially like my economic analysis and stuff like that. So I just
Mhm.
occasionally get people reaching out and saying like, "Oh, well, like, what's your story? How do you get started?" And then yeah, I always take calls like that just to help people out. And I like seeing other people succeed in the industry, so I would say I do that a lot.
Right. Yeah. Again, that's one of the reasons we do this show is just to, a lot of people were gracious with their time early on as we were getting started, and gave us some ideas, time, questions, helped us, got some guidance. So, if we can, share some knowledge and drop some ideas on people through this podcast, as well as other things that Bill and I do, we're all about that. So definitely very nice.
Mhm.
Well, Kunal, is there something you've recently implemented in your business that's allowed you to continue to grow and scale as you roll out the debt fund?
Yeah, so I think one change that I've made pretty recently is kind of shifted away my focus from retail investors. So I think previously what we were doing is just advertising directly to retail, doing word of mouth to get more investments. And so our minimum investment for a retail investor is like 50K at the current moment. But so we have around 6 million in the debt fund right now, and the goal is to grow that to 20 million. And so you can imagine if you're taking 50K checks at a time, it's going to take a lot of checks. And then for each check that you take, you're going to make like 100 phone calls. So, I mean, it's pretty difficult to scale super quickly that way unless you like build a huge infrastructure, you get a team together. So instead, what I've been doing more recently is focusing on fund of funds managers. So there are a lot of people who raise funds just to invest with other operators, not necessarily to invest in their own deals. And so
Mhm.
more recently, I've been focusing on that demographic. And so, yeah, that's going pretty well. I think that's, I mean, I have a couple of fund managers in the pipeline, and I think that's going to help us scale a lot faster. So that's a pretty major change I've made.
Yeah, absolutely. Yeah, yeah. Mid six, seven figure checks definitely helps that count go up a little quicker.
Yeah.
Yeah.
Yeah. Death by a thousand paper cuts,
Right.
Mhm.
the other way. And anyway, so Kunal, what advice would you share with somebody who's considering making a path change?
Yeah, I mean, I think it kind of depends on what their goal is, right? So, I mean, I think if your primary objective is to have more free time or do something like that, I think I think you need to be careful with how you switch because the way that you can so my background is real estate, so I'll talk about switching to real estate. I mean, I think like you can get into real estate and work 3x as much as you were at your previous job, or half as much as your previous job. It kind of depends on like what specific niche you get into, or like what your actual objective is there. So I would say like if you're trying to switch into real estate for the purpose of maybe having more free time, more passive income, working less, I would say like be pretty strategic about when you decide to switch, because generally for most people it takes a pretty long time to get to enough capital and enough investment to the point where it is actually passive. I think
Hmm.
um, people kind of underestimate how much work actually goes into it up front. The other angle I would say is like if your goal is to switch to make more money, not necessarily save more time, I would say the key metric to look at is kind of your return on time. So like if you can spend an incremental hour on real estate, and that is actually going to generate more income for you than it would if you're at your doing that additional hour at your current job, then I think if your goal is to maximize your income, it makes a lot more sense to switch. So I think those are the criteria I would use if you were trying to make a change.
Nice.
Yeah.
Yeah.
Yeah. Very good. Well, Kunal, what's the best way for our listeners to reach out and learn more about what you have going on or more about the debt fund?
Yeah, I mean, I post a lot of economic analysis, like I mentioned on LinkedIn. So that's a pretty great way to just get connected with me, see what we're up to, and keep up with the debt fund. You guys want to learn more or you want advice, like I mentioned, always feel free to message me on LinkedIn. I pretty much respond to anybody who messages. So yeah.
Okay, great. Well, we definitely appreciate the conversation today. Really enjoyed it, and we want to wish you continued success with the debt fund and your future endeavors.
Awesome. Thank you guys.
Absolutely.
Yes, thank you, Kunal. We appreciate your time. Thanks for being on. We also want to thank our listeners. Please continue to give us a 5-star rating so we can bring you more great content like our show today with Kunaal Kumar. And we also want to remind everybody of a couple important things that Park Capital Partners has going on. First, we have the Park Capital Partners Value Add Fund, which is a 506c fund open today to accredited investors. Second, we have the Park Capital Partners Foundation, which is a 501(c) nonprofit that Bill and I created as another way that we give back. The way that works quickly, first, Bill and I fund it through our company to make sure that all the money donated goes to do its best work, which is to help others. Second, we donate personally. Third, we donate corporately. And fourth, when investors invest with us in one of our projects, we make a donation to honor that investor to a pre-selected list of 15 different charities that the investor gets to pick from. So please reach out, say hello. We're happy to have a conversation anytime. ParkCapitalPartnersLLC.com, ParkCapitalPartnersLLC.com. And remember, folks, the road less traveled may be calling you. We recommend that you listen and take action. Thanks for joining.